Hello and welcome to this very special episode of Crystal Ball, coming to the end of what has been a pedestrian year for the equity market, and as we look forward into 2016, also at the end of a year where we've got over 60,000 crores from domestic investors in the equity market after such a long time. My guest today on the show to talk about the sustainability of these flows and whether 2016 will be an improvement on 2015. Manish Chokhani, Director of Enam Holdings. Manish, it's a pleasure to see you as always. It's been a disappointing year in a sense, with so much money having come in, but the market's returns have been lukewarm. Do you think 2016 will be substantially better?
Well, Udayan, let me start by saying that what I thought at the beginning of 2015 did happen. So I'm certainly not in a position to really say with great certainty what happens in 2016. Because let's look back a year from today. If I had told you Indian interest rates will be down by 200 basis points and oil will be down by 25% almost, and you will see $15 to $20 billion of private equity inflows, and you will see, as you said, $10 billion of domestic inflows, I think we would have painted a scenario where this market should have probably been 20% higher. So what has happened when I look back in hindsight is that the world seems to have fallen into a sort of deflationary rut, and every asset class across the world has suffered massively. So the best developed world markets are minus 10%. I can only think of Japan, which is in positive. The rest of the developed world is minus 10. India, China are 10% down. I think Russia is 20 down. Brazil is 30 down. Foreign inflows into India for the first time this year, I think net inflows of FIIs are only $3 billion, which at one point was, I think, 8 or 9 positive, and it's reversed and become only 3 positive, which means 5 or 6 has gone out. And a lot of that 3 billion went into also primary issuances and QIPs. If I look across at the commodity complex, gold and silver are down 10%, oil is down, as I said, 25%, and every single commodity is down 30%. If you look at real estate, that's down as well. So it's been a tough year for investors all over the world to hide out. And frankly, the story is more global in nature than what we're doing here. And my hope was that India will stand out and we would have pushed our reform and GST forward in the budget. But I think not having that session working cost us very dearly. And if you realize, the market peaked out just around then, and it's really been a downhill ride since then. So moving on to 2016, we are back almost where we were when the year started. We're looking forward to this session of Parliament again. Hopefully the budget session starts seeing the income tax and corporate rate tax cuts which were promised. Domestic inflows continue. The foreigners who had to withdraw money because of the Fed hiking rates, all that would have hopefully been behind us. And therefore most of the gains in some sense from this mood of pessimism we are currently in could be front-loaded in again the first half of the year next year, while earnings will still take a long time to follow. So that's the sort of murky backdrop in which I think we are entering this year. You used a fairly explosive phrase, this deflationary spiral, and that's the core of the worry as you look forward into the future as well. Do you think that theme will change, or do you think we are stuck in a bit of a rut globally, which it might be difficult to get out of, while we'll have these trading bounces and rallies like we saw in October, depending on what the Fed does or the ECB does? Do you see a fix to that problem anytime in 2016, durably? No, difficult. And we've spoken so many times all over the years that the crisis of 2008 in a sense never got fixed fundamentally. It got plastered over with liquidity, trying to alleviate the pain and stretch things out. But reality is that businesses are broken all over the world. The profit cycle hasn't recovered really anywhere in the world. And what we're seeing therefore with this easy, cheap money being thrown at the problem is that people have started taking outsized risky bets. And that's showing up, for example, in various technologies in the private equity domain where I happen to have a ringside view as well. And you're therefore seeing people making moonshots, making rockets for the moon, trying to create infrastructure which electric cars will ride on and the state will pay for. So they are audacious goals which only happen when money is very, very cheap. And if I think back in terms of classic market cycles, this time we didn't allow the cycle to operate because the basic force of gravity which was interest rates, which should be market determined, this time were completely manipulated by the central banks. So in a sense, the sort of collapse in phase 4, which we classically see after a peak of phase 3, rebounded quickly. We got a phase 5 rebound, which got extended out. So the last 3-4 years, in my sense, have really been an extension of the previous bull market rather than the start of a whole new one. And that's why you're seeing a large majority of the world still in a deflationary downward spiral, and you're not seeing that profit cycle coming back. And in a world with 1 or 2% interest rates, if you can still buy Apple and Microsoft at 10, 15 type PE multiples, it's just telling you what the world is apprehending going ahead.
You spoke a lot about this domestic money which has come in 2015. Let me just take you back to the previous example of such strong inflows. I was looking at the data, and the last recorded big inflow year was 2008, the year in which the market tanked 50%, and domestic equity inflows were the largest ever at 73,000 crores. And after that year, or after 2009, the domestic money sort of went into a sulk for 5 or 6 years. Having put in so much money late in the game, having missed out 12, 13, 14 in 2015, is there a risk of that recurring if there is even a small accident with equity prices in 2016?
So I hope not, although you're right that typically retail does come in towards the end of a cycle, having seen this market literally double from 15,000 to 30,000 index. That's really when the bulk of the money started coming in. And my hope really is that India finally, after, 10, 15, 20 years, does make a positive case for itself for money to be attracted here than an absence of negatives. As in, if oil wasn't $40, I don't know if we would be making such a strong bull case for India. If we didn't have this GST bill being so imminent for the last 10 years, and it finally culminates and hopefully gets done in the next 12 months, hopefully that starts setting the case for a new revival of a profit cycle in India. Because if this time we blow it for our domestic money, I don't think this time we can afford that demographic bulge, which is beginning now 2015 and rises all the way to 2025. This really has to be India's period in the sun. And this is when our GDP has to go from, whatever, 1.5, 2 trillion to 5 trillion. This is when our market cap really has to double and triple. And that sort of leadership which one is hoping for is still not really visible. And bull markets typically get ignited with cheap money, which we do have in the rest of the world. But you also need a big profit opportunity, which is so easy and obvious that it ignites the animal spirits of the economy. If you recall, the 2002-03 bull market started off with privatization and this lift-off in commodity prices. This time you're seeing that animal spirits only in the sort of tech space, which private equity is infusing into the Flipkarts and Snapdeals of the world. But it's not a widespread sort of profit cycle. And even in that space, actually, I think Flipkart's on course to probably losing $800 or $900 million a year. So it's not really a profit cycle. It's an investor-led cycle, if I could call it that. So the signs are not great. I love being an optimist and a bullish person at heart, but it's very hard to make that case. And counterintuitively, that may well be the case that expectations are so low that you might well end up creating a year of positive returns, unlike last year when we all started very positive and ended up negative.
At this point, we'll take a quick break. Be back with Manish Chokhani of Enam Holdings in just a minute.